Welcome to This Explainer. Okay, today we are going to completely demystify that scrolling ticker tape of global currencies you always see flashing on financial news networks. We're locking in the absolute foundations of Forex trading. So if you've ever looked at those charts and felt just a little bit overwhelmed by all the jargon or the endless numbers, you are in exactly the right place.
Let's just tackle the elephant in the room right away. It's the fundamental question everyone has when they first see these confusing symbols, right? Stuff like Euro USD or GBP USD on a screen. Like, what exactly are you even buying or selling here? Honestly, it looks more like an algebra equation than a financial asset. But I promise, mastering this one concept is basically the master key to reading the entire market. Once you get this, the rest of it just kind of clicks into place.
Section 1. Why currencies are paired, the foundation of Forex.
All right, so the absolute core rule to remember, and this is literally the bedrock of the whole system, is that a currency pair is simply the value of one currency compared to another. In Forex, you can never ever buy or sell just one single currency in isolation. It just doesn't work that way. They are always, without exception, traded as a pair. You are always measuring the value of one thing directly against another.
And you know, a travel analogy actually illustrates this perfectly. Imagine you're hopping on a plane, traveling from Nigeria to the United States. Well, to buy anything once you land in the US, you have to exchange your Nigerian naira for US dollars, right? You are literally giving up one currency to receive another one. And honestly, that is exactly how the entire Forex market operates on a massive global scale. Every single trade is just an exchange of one currency for another. Moving on to Section 2. Base versus quote currencies, deconstructing the pair.
Okay, look at how cleanly the item being traded is separated from its price tag here. Over on the left, we've got the base currency. That is always going to be the very first currency listed, and it's the actual main item you are buying or selling. Just think of it like a physical product you're taking off a shelf. Then, on the right, is the quote currency. This is the second one, and it simply tells you how much of that specific currency you need to buy exactly 1 unit of your base currency. It is, quite literally, just the price tag.
To put that into perspective, let's look at a specific exchange rate. Euro/USD equals 1.1500. What does that actually mean in plain, everyday English? Well, it just means that 1 euro, which is our base currency, the item, is worth exactly $1.15. The euro is the product in your cart, and the US dollar is the price you're paying at the register.
Now let's see what happens when the price actually starts moving on the charts. If that number ticks up to 1.1600, it now takes more dollars to buy a single euro. That means the euro has strengthened against the dollar. But conversely, if it falls down to 1.1400, it takes fewer dollars, right? Meaning the euro has weakened against the dollar. Just remember, you are always tracking the strength or weakness of that very first currency, the base.
Let's get into Section 3. Buying and selling explained. Making your move in the market. So let's actually walk through the exact steps of buying. Basically, you execute a buy order when you fully expect the base currency to increase in value compared to the quote. For instance, step 1, you hit buy on GBP USD at 1.3500. Then, step 2, let's say the price rises to 1.3600. Boom, the British pound has gained value against the US dollar. Finally, step 3, you close that trade out for a profit. You bought the item, it went up in value, and you sold it back to the market. Simple as that.
But hey, we can also do the exact opposite. When you're selling or shorting, you're expecting the base currency to lose value compared to the quote currency. For example, imagine you sell USD/JPY because you really believe the US dollar is going to weaken against the Japanese yen. Well, if you're right and the price actually falls, your trade becomes profitable. You are quite literally profiting from the downward movement of the base currency. Pretty cool, right?
And honestly, that brings us to a massively important realization. This ability to profit from both rising and falling markets is one of Forex trading's absolute biggest advantages. Seriously, it's a total game changer. You aren't just sitting there stuck, desperately hoping things go up. By understanding how base and quote currencies interact, you unlock flexibility and opportunity in literally any market condition, whether it's soaring to the moon or crashing back down to earth.
Let's look at Section 4, Types of Currency Pairs, Understanding the Landscape. Out in the wild, you're generally going to encounter 3 main categories of currency pairs. First up, we've got the major pairs. These guys always include the US dollar. They are the most heavily traded pairs on the entire planet, which gives you high liquidity and lower trading costs. Think heavyweights like EUR USD or USD JPY.
Then we have the minor pairs, which you might also hear called cross-currency pairs. Now these involve major currencies, but they leave out the US dollar entirely, like EUR-GBP or AUD-NZD. They're traded just a bit less heavily than the majors. And finally, we have the exotic pairs. These pair up one major currency with a currency from an emerging economy, like the US dollar and the Turkish lira, so USD/TRY. Because they're traded way less frequently, exotics tend to experience much larger, wilder price movements and wider spreads. Definitely something to keep an eye on.
Okay, before we move on, I really want to give you this incredibly easy reading trick. If you see EUR/USD equals 1.2000, just read it like this in your head. It costs $1.20 to buy 1 euro. That's it. Just read it left to right, base first, then the quote amount. Once you lock that little mental shortcut in, I promise, anytime you look at a pair on a chart, the price will instantly make total sense.
All right, Section 5, Avoiding Common Beginner Mistakes, the Golden Rule.
So I want you to ask yourself this. When you hit buy on Euro-USD, are you actually buying both currencies? A lot of beginners see that little slash between the symbols, and they assume they're acquiring some kind of basket containing both euros and dollars. Let me be super clear. That is completely, 100% incorrect. No way.
Which leads us to the crucial point here, the Golden Rule. When you hit buy, you are buying the base currency and simultaneously selling the quote currency. And when you hit sell, you are doing the exact reverse, selling the base currency while simultaneously buying the quote currency. You are taking opposite actions at the exact same time. It's an exchange. If you can just sear this rule into your brain, you are going to avoid one of the biggest, most common pitfalls in all of Forex trading.
Okay, let's do a super quick recap just to make absolutely sure these foundational mechanics are locked in for you. 1. Currencies are paired simply to compare their relative value. 2. The base currency is always listed first, acting as the item, while the quote currency is second, acting as the price tag. 3. You buy when you expect the base to strengthen, and you sell when you expect it to weaken. And finally, those pairs are grouped into majors, minors, and exotics based entirely on their liquidity and the economies involved. Boom, you've got it.
So now that you completely understand the mechanics of how these pairs are structured, read, and traded, it leaves us with one massive lingering question, doesn't it? How do exchange rates actually work behind the scenes? And what fundamentally drives these currency prices to rise and fall in the first place? Well, that is where the real market analysis begins. Thanks so much for joining me for this explainer. Keep studying those charts, and I will catch you next time as we continue to unpack the global markets.